Welcome to another episode of Bitcash Breakthrough, your gateway to digital wealth. Please welcome Andrew Tu, the head of sales at Efficient Frontier, a market maker in crypto, where he has been doing sales for the last 5 years. Andrew ventured into the crypto world in 2014 through the Bitcoin Association of Berkeley, now known as Blockchain at Berkeley. After college, he contributed to the development of Partial F, one of the earliest DeFi derivative protocols, in 2018 alongside his peers from Blockchain at Berkeley. Welcome, Andrew.
Thanks for having me, Joe.
All right. So yeah, pretty early. So you learned about Bitcoin or got into crypto in 2014. Did you know about it before you joined Blockchain at Berkeley, or?
I joined a bit randomly because there was back in the day people used to use Facebook and there was like a Facebook group for every class in college, and someone randomly posted join the Bitcoin Club, there's free pizza or something, and I had known about it because I was libertarian in high school, starting in high school. So I had known about Bitcoin, but I didn't know so much about it. But it seemed interesting as an idea, and so then I joined the club, and everything has kind of happened since.
Yeah, that must have been pretty much a whirlwind. It was amazing to see how active the students at Blockchain at Berkeley were in this space, even just alongside industry, like growing with the industry. So what was your experience like there in 2014, 15, probably a few years, right? 16.
Yeah, I'd say 2014 to 2016 was one iteration, which was the Bitcoin Association, which was a lot smaller, a lot more informal, like relaxed, just mostly getting together to just talk about what's happening. And I think that kind of mimics the industry, right? Like 2014 to 2016 was quite a quiet time. There wasn't so much going on. And then 2016 onwards, fall 2016 onwards, you start to have people exploring enterprise blockchain, and people start to even use the word blockchain a lot more. Like people didn't use the word blockchain so much like that. Like people would say the blockchain before 2016 or 2015 because there was really one blockchain that mattered. And then yeah, things started to change. And then of course 2017 you have the ICO bull run. And so that's what allowed the club to explode. And you really have in that 2017 year, 2018 year, a ton of interesting stuff come out of Berkeley. The Berkeley ecosystem has always been pretty strong. We have the accelerator on campus. A lot of the Cosmos ecosystem came out of Berkeley. You also have a lot of VCs in the space. A lot of Cal kids end up joining VCs. Yeah, there's a lot of interesting stuff that came out of that ecosystem. And one of those things was Partial F.
Yeah, we could talk about that as well, but I'm curious so it started as a Bitcoin association, but I remember knowing or meeting you through the Blockchain at Berkeley club.
Yeah.
And so I guess in the early days, did you form more of this? Was it always similar, or did the official, when especially 2014, 15, 16, what were you doing in the meetups there, discussing Bitcoin and Litecoin? There wasn't a lot to talk about.
Yeah, there was interesting stuff. I would say what predicated that change was certain new people joining who are like, look, there's a kind of wave of like a blockchain wave. So you have we had some folks join the team who thought rebranding to Blockchain at Berkeley, given that enterprise blockchain boom at the time, or the new buzzword on the block, would be helpful. And also the industry moved right from where it was. In the 2014, 15, 16 era, mostly we're just talking about what happened in the last week in the Bitcoin space. We did some cool stuff, like we did a hackathon, probably one of the first college hackathons focused on Bitcoin blockchain in fall 2014. And
Wow.
we did it again in I think it was 15 or 16. And what really maybe made the club take off was we started teaching a class on Bitcoin and cryptocurrencies, because at Cal, any student is allowed to teach a class for actual school credit. So we started this class in I want to say 16 fall or something like that, or maybe even 2016 spring. And that really is what really allowed the club to start to grow a lot. And then we started doing consulting. So we actually, looking back, it's still crazy, but we managed to do a consulting gig with Airbus. And pretty much every semester since then, we've had a consulting gig. I think even now, they've had like a consulting gig with some sort of Fortune 500 company doing some sort of enterprise blockchain thing.
That's amazing. Yeah. All right. So from the beginning all the way to hackathons 2015, 2016, and then going to, and then the classes. So I guess you were recruiting a lot of people who attended the classes.
Yeah,
you were
exactly.
teaching, and then
Exactly. So people would be first exposed to crypto through the class, or at least on a deeper level. And then some of those folks would join the club. And yeah, it ended up being very fleshed out. So we ended up by 2017 fall, we had a research division with like people building stuff. So there was a couple of friends of mine that built like a plasma layer 2 chain project, and that kind of plasma later became less relevant compared to optimistic rollups. So still, that was a very early kind of layer 2 kind of project. One of the teams that came out of the research arm was like Open, which a decentralized options protocol in the space. If you've heard of like Squared ETH, which is also like an interesting kind of financial product that came out of BAB. So there was a research division, which probably was the coolest division. Then you have the consulting arm, which was like doing consulting for Fortune 500s or like related to blockchain. And then there was a education arm, which was teaching the classes on campus. And so at one point, I don't know about now, but at one point we had one class on fundamentals of blockchain and the philosophy of it and cypherpunks, all this stuff. So a more high level class. And we had another class that was just teaching smart contract development on Ethereum. So yeah, at that point, that was like probably, and that's the semester I left pretty much, was when we had these three arms fleshed out.
Yeah, that's amazing how you guys were able to get so closely tied with the industry on the consulting side, just teaching. I remember attending some, they weren't probably the part of the official curriculum, but you guys did some other educational outside in the campus. I remember going to a few of those, and then just the projects that came out. I'm interested. You mentioned a couple of DeFi projects. Probably some protocols came out of the research team, or at least some professors in Berkeley, I think.
Yeah. There's some stuff
Yeah.
like that isn't directly affiliated with BAB, but maybe semi-affiliated. So there's the accelerator, which works with BAB. Then Dawn Song, who is a professor at Cal, she has her project Oasis, right? So
That's what I was thinking about. Yeah.
there's a great ecosystem. And Sunny Agarwal, who was a buddy of mine, he was like a very important early contributor to Cosmos, and is one of the current co-founders of Osmosis alongside Dave, another friend of mine from the club. So yeah, a lot of interesting stuff came out of that club. There is a Berkeley Mafia, but I remember June, you went to Cal too, right?
Yeah, but that's so long ago. I don't even I don't even want to date myself. But yeah, it's good to see you. Go Bears, right?
Yeah, go Bears.
And yeah, so Sunny is another kind of big guy in the Cosmos ecosystem, and Osmosis is doing well. So it's great to see all the successes. And then some hedge funds. I know Jonathan Allen he's part of a investment firm, right?
Yeah, a lot of guys from the club ended up joining VCs and funds and this sort of thing. So Dimitri, John, Honan, this sort of thing. Yeah, there's a lot of interesting people from that club. And even until now, there's still students who are doing interesting stuff. And pretty much we usually have a contingent of alumni and current students who are going to conferences. So usually, at least at the American ones and also the major global ones, there's always some kind of Berkeley meetup at one of these conferences.
Yeah, and you guys were also doing a lot of events, at least back in the 2018 period, 2019, maybe 2020 or so. The blockchain week, right? You guys were doing a lot of that, which was great in the area, in the Bay Area.
Yeah, we had the Berkeley meetup, which used to be really solid, like technical meetup. And I think BAB was one of the basically people in BAB pretty much founded SF Blockchain Week. I don't remember when that was. And we also have CESC, Crypto Economic Security Conference, which was a part of SF Blockchain Week. So yeah, there's stuff that's pretty much, and I think CESC and maybe Blockchain Week, but for sure CESC still happens in Berkeley and is still a thing.
Yeah, definitely have to go back. I remember attending a couple of times, and always a lot of great research talks. Definitely. Very technical, but very useful. And they're the early ones. Lehman Baird from Hedera Hashcraft spoke, and then guy from
Cosmos spoke, Silvio Macaulay or something from Algorand spoke.
Algorand spoke. And this was before they were like years before they even launched their projects. So it was very early, very like early alpha in the space. So you always want to go to the academic conferences for the cutting edge projects in crypto and blockchain. And then right after you graduated, you moved over and then you worked on a derivatives project called Partial F with former colleagues
Yeah,
at school.
maybe friends is a better word than
Okay.
colleagues because,
Okay.
but yeah, we were all part of Blockchain in Berkeley, and all those friends from Partial Left are now doing something pretty neat as well. But yeah, we were probably one of the earliest decentralized derivatives products in the space, and we wrote a really neat white paper and built it out. But at the time in 2018, it was really a difficult time to raise. We actually ultimately did get some yeses, but things just didn't seem right, and we ended up not accepting those checks. But maybe we should have, and we would have made it through DeFi summer. But yeah, 2018 was way too early for anything in DeFi.
Yeah, you were before DeFi summer, right? So that was 2019 then, right? Was it
No,
around
DeFi summer
20,
was summer
20
20. So we were actually a bit
2 years?
more than 2 years early because the research was
Yeah.
being done in the end of 2017, early 2018. So yeah, basically interesting, very interesting stuff. But it was way too early of a product, and we probably would have had to pivot like everyone else has pivoted over the years. But some of the early competitors to that product were like Haven, which is now Synthetics, and DYDX, and both of those have since pivoted very sharply from the original products that they had envisioned. But yeah, we had built sort of basically we used like a MakerDAO CDP and adjusted the debt so that it was dynamic. And once the amount of the token that's owed back to the contract is adjustable, then you basically have this token as something that you can turn into a derivative product. So we thought about things like leverage tokens, inverse tokens, like an inverse Bitcoin, inverse ETH token, or a leveraged Bitcoin leveraged ETH token. So there's different ways that we could have played it, but it was a really interesting idea for the time. But yeah, it was just not the right timing, right? But the way it goes. So much
Yeah,
market is timing.
it's true. It's true. That's the lesson in startups. I think Mark Andreessen was saying that, yeah, it's most founders and companies are way too early, years too early. And it's even Netscape, when he thought he was like too late, but it was really, he was still early.
Yeah,
Then you had the Netscape moment. So
yeah,
that was
exactly.
his comment. Yeah, it's everything's too early. But it was good to know that you guys were on it. And I do the concept that you described, like creating some sort of synthetic token out of DeFi mechanics that you create. And but no, it's good to see, yeah, and all the other projects that have come out of it and had to pivot, and it's interesting. Yeah, DeFi, it seems to be a very strong part of, I think, at least the more fundamentally sound parts of crypto right now. Everything is driven by like memes and things these days. But I think when you look, at least the things that are going on in DeFi are exciting, I think, still progressing well over the years. So after that, you started with this company, right? The market making company. And so tell me a little bit more about how you got started there, Efficient Frontier, and just your experience with working as a market maker. And this be good, I think. Yeah, it'd be good to help people learn about what market making is. It's people trading crypto. You're oftentimes on the other side of the
Yeah,
trade.
sure.
Yeah, tell me maybe just how you got started first, and then maybe what market making is, and then we can go from there.
Yeah, at the time when I was at Partial F, we were looking for market makers to potentially make a market on that product or products that we would have launched, like the derivative products that we would have launched. And the way I got to basically Frontier or Fish Frontier is one of the co-founders of Blockchain in Berkeley was Israeli, and he made an intro to some of the co-founders at Efficient Frontier. And from there, we talked about Partial F and that those tokens. And when we shut down Partial F, I reached out to them for a job and I joined. So yeah, that's how I got to Efficient Frontier or EF. Let's say maybe to answer the other question, which is what is market making, because it is a very obscure topic. Basically, market making means to provide a two-sided market and to provide liquidity so that people can actually trade. Making a market basically means that there's people who want to buy this thing. It can be anything. It could be plants. It could be crypto. It can be ETFs, right? There's some folks who want to buy it and some folks who want to sell it. But you usually need a middleman to always act as this intermediary who's saying, look, who's saying to the buyers, I'll sell it to you. And saying to the sellers, I'll buy it from you. And this middleman is the market maker. So it could be with something as simple as, theoretically, I had a buddy who was trying to make markets for exotic plants from Asia to the United States. But in the crypto conference, it's in the KIP context, it means trading in the order book and providing two-sided liquidity, meaning putting orders into the order book, let's say multiple orders on both sides, so that anyone who wants to buy can buy in size, and anyone who wants to sell can sell in size. And that makes ultimately the market more efficient, because the more liquid the market is and the more money, more size, let's say, you can put into the market without affecting the price, the more efficient a market is and the better price discovery tends to be. So that's real market making. And then you have the other bells and whistles that people like to do in this space, which is all nonsense. So a lot of retail in crypto tends to associate market making with market manipulating or wash trading or pumping or all these things. But these are all not, let's say, inherent to market making itself, and are also illegal. So real market making just means providing liquidity to the market, and everything else is additional features that some of these, let's say, gray area, black area market makers do.
Yeah, that sounds great. And then since you mentioned that topic as well, so you're saying there is this foundation of market making, that which makes sense, is you're helping provide liquidity for buyers and sellers. But then some people know it more for kind of the other side of it, the negative side of it, where it's more. But yeah, I'm curious on that side. There are, especially with meme coins and whatnot, there's ways to provide a lot of maybe liquidity at certain points in times to pump the price of a token very high, and then that allows early investors to sell, like dump. What do you think about that? And some of the mechanics, though, you could, as a market maker, you could understand how that can work. Maybe you can explain the process of that. And there may be some market makers that use that, right? That use that strategy to maybe make money against the market as well. And so I wouldn't, not all market makers are clean in terms of manipulation or manipulating the market. But how does that work? And how much can you gain by doing those kinds of, using those kinds of maybe illegal practices? I mean,
Yeah.
it's
Well, there's one name that I won't name
mm,
drop, but if
mm,
you just look on Twitter, you'll find it very quickly. That has become famous for pumping and dumping. But pumping and
mm,
dumping in crypto has been a thing for a long time, since before 2017, right? People find the fact that basically people know they can manipulate retail psychology to buying into an asset when it's going up. So you basically start the pump, right, by buying up the token, but you're not investing in it, right? The market, let's not even call it market maker. The per has already a plan to dump the token onto the market. So he basically pumps it and buys a certain amount, right? And other people join in the pile. Other retail traders are like, oh, look at this, it's going up so much, we need to get in, right? And it manipulates retail psychology to enter the market. And once you have this snowball effect of retail entering the market, then the market maker, or really let's call it the dumper now, the pump and dumper, starts to dump off his share and basically smash the market. And so that's why so often you go up very quickly, and then there's two ways of going about it. You basically sell it off slowly, or you dump it off very quickly. Back in the day, it was more aggressive with the way people dumped, and now people tend to be a little bit more nuanced, or let's say a little bit more sophisticated in the way they're dumping off the asset. Ultimately, it's just buying up the token to generate this pump effect. Other people get in, and you start to sell off as other people get in. And by the end of this pump and dump, the price is where it was at, or even lower than where it was at. So there's one new market entrant from last year, or maybe, yeah, last year, who took off of this style of trading. But it's been in crypto for a very long time, and as long as it remains like a semi-regulated asset class, it will continue to be a thing. Thankfully, I can say at Efficient Frontier, we've never pump and dumped ever. We've never done a wash trade ever. We've never done any of these weird market manipulation games. But this is just a fact of the industry, right? When it's not fully regulated, it allows for freedom of building and doing cool things, but it also allows for more bad actors. Right. So at the end of the day, it's just about doing your own research and trusting yourself, and not what scammers or influencers are telling you to do on Twitter or something.
Yeah, so any words of advice for retail investors to have any additional signals? I guess the standard one is that, hey, all these influencers are talking about celebrities that come out of the woodwork promoting something. But aside from
Yeah.
that, is there any patterns that you see maybe on in the technical charts or anything else that you would advise for retail investors to look out for, to be careful?
It depends. I think with most memes, if the price has already gone up 5x, usually the train is already gone, right? Or that ship has sailed. And chasing it is usually a bad idea with certain exceptions, unless it's an asset that has real long-term, somehow like cultural demand, like a Doge, Shiba, Link back in the day with the Link Marines, with this cycle, right? So there's 1 in 100, 1 in 500 that maintain the upward trend. But the vast majority of these things, if you are not 24/7 on the charts and looking at what's going on, you shouldn't buy a token that's already pumped significantly because you're just setting yourself up to be dumped on by the original investors or by the people who have like a pre-mine exposure to the asset. So yeah, something to look out for also is like this, the word pre-mine is probably not the right word, but pre-existing ownership of the token, right? So what percent does the meme creator have in the supply, right? If it's a huge percent, then that's a problem. Also, like if it's a meme specifically, did the LP of the original pool, did he burn the LP tokens or did he keep them? Because if he keeps them and didn't burn them, he can rug the pool at any time, withdraw liquidity, and basically run away. So there's all these different avenues, but I'd say the biggest one is don't trade emotionally, trade as much as you can rationally and stick to a game plan. That's probably like the best general advice any retail guy can go in with, because to have like a reason for buying this thing beyond just it's already, and it can't just be it pumped 5x. That's usually a horrible reason to purchase something. Or you have a very specific, if it's already done the 5x, then you have a very specific game plan. Do you have a stop loss? Do you have a plan to sell off the token over time? This sort of thing.
Yeah, that makes sense. Yeah, just looking at just the raw movement before you buy it. Yeah, just 5x, even 4x is a lot, 3x, and things that are flat for a long time and maybe just starting to move is a lot better of a setup than things that moved up. It doesn't mean it's not going to move further, but you said if you're systematic, you have some protection and it continues, then at least you got some downside protection. And then how much can these firms make? Because I still feel like you still have to have a certain large amount of users to dump on, right? So unless it's a market is really liquid with real users that are FOMOing into it, maybe there's this exponential like hype around something that maybe there is that, but you still need a certain amount. So because I would imagine that you need, let's say, 20 million worth of real buying power to sell 20 million worth of tokens, right? And so you really have to have real action if you're trying to dump on people. So I just feel like are they generating that much hype to be able to succeed in these kind of tactics? I guess so, but what is your take? Isn't that true? Like you need real buying power that are buying at these high prices. Otherwise, it's not like you can manufacture that. You still need the real buyers. That's who unfortunately are losing out on it. So you need real losers to
Yeah.
actually to be like gaining on it. And is that's what's happening? Like every time it's like there's enough hype to draw people in out of the woodwork and to unfortunately invest at the kind of these high prices. And
Yeah, you don't have to sell at the peak, right? If you start to sell at
yeah,
the peak, but
yeah,
as long as you're selling above the price you bought in, if you're doing this kind of scam,
true,
then
true.
you're fine. All right. So that's why it always goes down because you're pumping it up. And then ultimately, once you start to sell and smash the market, right, as long as the price remains above average price you bought at, you can continue to sell off the token and you don't care what happens.
That's true. That's true. It's just so all the volume for the big time your entry point is all the way up. It doesn't have, you're not like you may have some sold at the peak, but then just everywhere in between you're making money. So that's like the total volume of that is what they're aiming for. So it's
Yeah.
fascinating. But yeah, just be careful out there. And yeah, you gotta, like with anything, just the safer thing is just to not go in, like you say, when it's already pumped up. So to avoid being dumped on.
Yeah,
Um,
don't be a sucker, right? Don't like if usually even with narratives, right? A lot of pretty much most of the industry trades based off of, or most of the market trades based off of narratives. And whether a narrative is real or not is a separate conversation. But people are buying stuff like, let's say, render because of the general deepen narrative. People buy Tau based off of this AI narrative. So you have certain and basically you have like category leaders, and you really need to be a category leader to benefit the most from a certain narrative. And then the narrative fades and the price goes down, right? So modular was a huge narrative earlier in this year. So Celestia was that big, was the category leader in the modular narrative. And so it rose with that, and now since then it's dropped off. But once the narrative has already taken place and people have pumped these assets up, it's the same. It's not as, let's say, aggressive or egregious as meme coins. But once the narrative has come and is there in front of you, unless you were there before the narrative took place, right? Or a narrative caught on, let's say. The best time to buy in is before the market, let's say, reprices it to a new high based upon some sort of narrative. So you have to get in beforehand. But once that price has gone up 3x or 4x or whatever x, because people are saying, oh, modular is such an important thing or whatever, right? Deepin UAs like Ondo is the category leader in RWAs, and it's benefited hugely from that. But once that narrative has already occupied the minds of people, it's usually too late to go in at that moment. That's not, once it's at the all-time high, that's probably not the moment that you want to invest. Sometimes it is, but if you do, then you should have a game plan. But if it's already gone up with the rest of the tokens in that category, then you really ought to consider, okay, what am I doing here? And do you really have a game plan to get out or to make money based upon this new price?
Sounds good. Yeah, just early in on the narratives as well. Otherwise, it could already have run its course by the time you invest in it.
Yeah.
So with EF, maybe going back to just the mechanics of market making, you do help projects as well get liquidity for their tokens sometimes. And so maybe you can address that aspect of it as well. So you market make, you have clients that may need some liquidity. They come to you, they say, okay, hey, can you make the market for our token? Maybe explain that part of the business if you want.
Yeah, so that's the side of the business that I'm on actually. That's maybe half of our business, which is the market making for tokens side of things. Basically, most assets in this industry without a market maker are fairly illiquid, right? Meaning that there's not enough capital or inventory sitting within plus minus 0.5%, 1%, 2% from the mid price so that people can trade it. If there is $50 or $500 within plus minus 2%, right? From mid price for an asset, it basically means it's a dead token. It's not possible to really trade it. What we do as a designated market maker for a token or a primary market maker for a token is basically enter some sort of agreement with the project to provide liquidity for the token. So they at least have a couple thousand, or maybe for larger tokens, tens of thousands, hundreds of thousands of dollars of liquidity sitting within the plus minus 2%, 1%, this sort of thing, which allows retail to actually trade and facilitates actual trading activity. If there is no market maker for many of the assets in the space, there cannot be trading activity because retail, even if you wanted to buy the token, wouldn't be able to do so. That's our whole role. And usually these structures, the market making arrangement tends to be a loan and option, which is the predominant structure for market making. The other model being a retainer model. But yeah, so you pretty much have these projects choosing to 1 to 3, maybe even more if it's a huge project, but usually 1 to 3 market makers to provide liquidity for the asset.
And you said loan and option. Maybe you want to explain that a little bit more?
Yeah, so the loan and option is basically a loan of the project token to the market maker, where the market maker also has an option or a series of options to purchase this loan. I'd say these days the industry standard tends to be multiple strikes. So let's say 1 at the money, or 1 that's near the money, or 2 that's near the money, and maybe 2 that are far from the money. But the idea is, and it's probably easier explained with an example, that let's just say it's $1 million loan and the strike, let's say, is $1. and the price goes to 5, then the market maker was able to make money by exercising the call option. And the project, obviously, their token went to $5, so they're happy. And so both sides are in a win situation, right? In contrast, if the price goes down 50% to 50 cents, right, the market maker doesn't make as much money. The market maker will totally hedge himself off in that scenario to not lose money. So the market maker will still make a little bit of money, but not a lot of money. But the project will not have paid USDT for the service. So it's yet again, it's meant to be at least not it's maybe like a win or at least a net neutral on the downside. And it's basically a model that was designed to align the interests between the market maker and the project. Now, the reality is that there are totally ways that you can, in a legal fashion, and also in illegal fashions as well, but let's just say the legal fashion. There are some folks who are more aggressive in the industry who can totally provide a horrible service with the structure because it's not a pure service, right? It's something that is a cross in between a prop trading activity and a service. Because it has that prop element to it, we're able to provide deeper liquidity, better liquidity, well, very tight on the spread, this sort of thing. But there is the risk that the market maker misuses the structure to harm the project, or at least to not provide a genuine service. But that's the loan option in a nutshell, is basically being able to exercise the loan or the option if the price goes up and the market makes money, or if the price goes down, then the market maker returns the loan in the token.
Okay. Does it incentivize market makers to be a little bit more aggressive with the option on the upside? You didn't notice maybe some...
It depends. We don't do that because we don't think it's good for the market. Some people might. But basically, if you have a strike that's fully out of the money, and this is the thing where a lot of projects might think they're getting a good deal, but they're not. So a lot of times projects end up thinking, okay, the higher the strike, the better the deal for me, which intuitively sounds right. But once you get into the nuance of it, you realize that it's not actually necessarily true. Because if the market maker still provided a perfect service when the strike was high, then that would be the case. But what so often happens is if the price doesn't reach the strike, and the strike is far out of the money, let's say plus 100% or plus 200, so the strike is far out of the money, and the market maker cannot, and the market maker doesn't, or the price doesn't get to that strike, then the market maker is never in a position where he's able to really properly take risk, because the loan option is really a straddle position, and the straddle position is what hedges off the market maker from price risk on both the up and downside with the loan, and is also our upside, right? So it's both a hedge and our profit. But if we can't use it effectively as a hedge, then what ultimately happens is that the service will be subpar. So any option strike where the strike is fully far out of the money ends up being a poor deal for the market maker. But because the market maker has such a poor deal and cannot take risk, he can't provide KPIs to the project. And ultimately, even though it sounded like a good deal for the project, it ends up being a bad deal for the project. And we've seen so many people come to us now over the years where it's like they basically were abandoned by the roadside by the original market maker, who didn't fulfill any of the promises that they said they would. And the market maker just, some of these more, and you'd be surprised, but some of these folks who have good reputation, or good brand at least, or big brands at least, but ultimately are not really providing a great service to the project. If the price goes to the strike and goes up and things go well, then great, then everyone's happy. But if the price doesn't do that and the market isn't super receptive, and basically when you most need your market maker to be there for you as the project, the market maker doesn't do anything because they can't, because of the risk. So that's basically the loan option. The risks of the loan option is that the market maker doesn't really provide a perfect service for the client. And so that's why we structure it in a way where we always have some position at the money or near the money.
Gotcha. Okay, so it's very important to structure the strike prices and effectively. Otherwise, you won't get the aligned incentives. It makes sense. In terms of market making in general, like maybe advice to projects, it seems as though you want to attract traders and investors or active investors to provide this liquidity. It doesn't seem like a natural thing for projects to focus on, but it is important to be able to have this liquidity. But that requires not so much maybe buy and hold people, but it actually requires active traders, which is a different segment, right? So how do you, what do you tell projects about that? And yeah, what are your thoughts about that? What do you need to attract to have this level of liquidity that actually is will be helpful for your project in general, so that people can buy and sell and whenever they need?
Ultimately, the more demand there is for a product or a project, the more, regardless if that comes from the product itself or from the marketing. And if we're being real in crypto, it's usually the latter, right? Marketing community, this side of thing, does much more for token demand than the actual product, usually. Just a positive correlation. You always end up, the more demand you have, regardless if that's like hype or whatever, the more active trading you'll have. And the more trading activity you have, the more depth and volume you'll have organically from the market. Most mid small cap tokens fundamentally need a player like us to be in the book, because without us, there's not enough liquidity for people to even trade, right? To even you have this chicken egg thing. But for the large cap tokens, they already have enough organic liquidity. They just need maybe an additional boost of depth to make it easier for bigger players to come in and trade. But pretty much it's market making, and it's not like a solution in of itself. Ultimately, it's to build a market, you need the trading side, the market making side, and you also need actual demand generation. So community, marketing, product, all these elements have to also come into place. Don't think that just having a decent market maker will solve all your issues. No, like the actual, you still have to do the heavy lifting with the marketing side of things. Because if you have something we say often is, even if you put $1 million in the order book, if no one is there to trade it, if no one cares about this, then you still won't have very much volume. You might have some bots there, but you still won't have very much volume. So ultimately, you need to generate the demand side for the token for there to actually be real trading activity.
Gotcha. All right. And then I guess, I guess the advice is at least generally just focus. You could just focus on your project and your product and get the organic demand. That seems like a good approach. And I think from what you're saying is, though, even though it's buy side demand that you're generating, that probably will generate like the buy sell demand. Generally, you want to have a positive demand, but I'm just thinking liquidity is also buying and selling and having traders as well. But it seems, at least it seems to suggest that, hey, if you do have this, just at least the demand side, the marketing side, that with people aware about your coin, you're going to probably naturally get also like traders that just buy and sell. And so it's not necessarily just one-sided. It actually will create both sides of the market where there's just a lot of more trading activity in general, it seems.
Yeah, exactly. Most of the trading activity in the space comes from active traders, right? Not passive traders. And that's just a function of people knowing about your token and being excited about it.
Okay. And it's probably some sort of snowball effect where, okay, more people who are trading this for whatever reason will give more liquidity to actively trading it back and forth. And then that'll attract even more active traders that say, okay, hey, these early active traders are trading this. And yeah, so that does seem to make sense there. Okay. All right. Any other interesting things just on market making in general you want to share? Just any insights or things that maybe people don't know much about that you think is interesting or you'd like to share?
In general, I'd say the whole market making relationship is one of trust, right? If someone wants to screw you, right, if you feel any red flag with this dude, then you probably shouldn't go with him, because even, I tell this to a lot of folks, but even if you put safeguards around the activity, there's always some way to get screwed if he really wants to screw you. And if he really doesn't want to screw you, and it's one of those things based on trust, you have to figure it out by the vibe he gives off, by how much he's helping you, all these different aspects. But if someone doesn't want to screw you, he won't screw you no matter what. And if someone wants to screw you, he'll screw you no matter what kind of clauses you put in the contract, no matter what kind of safeguards you try to put in. People will always find a way to do you in if they want to, and they will not do you in if they don't want to. So ultimately, it really is a game of trust with regards to, is he really going to do what he says he's going to do? Because that's the biggest issue with most projects, is they're not traders. They don't understand trading. They're coming into this thing blind. They have some advisors. Maybe they know what they're talking about. Maybe they're just idiots, if we're being honest. A lot of them are. And a lot of these advisors, too, are being paid by the market maker referral fee. for being very straightforward. So how do you know for sure your advisor is really neutral, really giving you good advice? Well, a lot of times it is based on trust, ultimately. Do you trust these guys to do the right job? And you also have third party guys these days, right, who are doing like RFP for market making proposals. We've spoken to multiple projects who have gone through RFPs too, and they've not been happy about, even with a middleman who's meant to be negotiating for them and helping them out. So ultimately, a lot of it really is based on the relationship and the trust, and are you doing the right thing? And happily, we can say we've never screwed any of our clients intentionally or unintentionally, but we've never done anything to pump and dump a client, never done anything to wash trade, never anything like that. And yeah, you really want to have someone who has, it doesn't have to be us, but you want to be with someone who is with that kind of attitude, and not, if someone is saying to you, I can do everything, that usually is a red flag, unless you're building a project to rug people. But then if you're doing that, then anyways, you don't care about ethics. But if you're building a real project, then you want to have someone who gives off the attitude and the vibe of he's actually in it with you and he's super open with you about what's going on.
All right, that's great. So yeah, if people are looking for a market maker, should at least talk to you guys. And it seems like a very uh, space finding the right market maker. So you gotta forget the formalities and just talk to people and see if it's you can build a good rapport with them.
Yeah, a lot of it ends up just being that, do you have a good fit is what you want, what they're giving. But yeah, you want to make sure that they're really going to do what they say they're going to do, and that's the hard part.
Okay, sounds good. Anything dealing with exchanges that you have any insights or advice for people? People always look to list on exchanges, and you have to trade on those exchanges as well. And any insights there, where just in general?
Yeah, basically for something like Binance, where they've Chinese walled off their listing team, it's not something where we can actually make an intro, right? So the market makers and investors usually can make an intro to every exchange or to most of the exchanges. Binance is usually a trickier one, at least from the market maker perspective. I think some investors in the space will have that relationship, but not the market making side. They have a pretty strict Chinese wall. With regards to listing, I'd say these days you have pretty clear tiers. Binance is like a tier S or a tier 0. Coinbase, OKX is a tier 1. Bybit's like a tier 1.5. KuCoinGate's like a tier 2. And MXC, it's like a tier 3, right? And you have some other ones like Crypto.com, which is like maybe between a 2, maybe 2.5. Let's say at 2.5. So you have these clear tiers, and you also have accompanying those tiers like fees that pretty much match those tiers. MEXC, or Bitmart are more lenient with their listing requirements, but then let's say charge the least, right? Versus KuCoin, Gay charge more, right? And then Bybit will charge more than them. And Bybit has been the biggest benefactor of some of the recent events in the exchange space where there's been a shuffling around, but a lot of flow has been going towards Bybit, especially on the altcoin spot side over the last year, especially because they've been, let's say, the exchange of choice for a lot of, let's say, tier 2 decent projects in the space that can't get onto an OKX or Binance or Coinbase straight away. But if you want to list on a tier 1 or even a tier 2 exchange these days, it's not like before where you just pay to play. You need to come, if you have an enormous treasury, then maybe it is. But usually those projects with enormous treasuries already are legit anyways. But you need to bring more fundamental statistics, or at least let's call it fundamental, because some of these probably are still gameable, but let's say less easily gameable than stuff in the past. So whereas the past it was Twitter and Discord and Telegram group chats and this kind of stuff, and maybe your investors, what's the pedigree of the investors, and now they're just having a Silicon Valley investor isn't enough to get onto a Binance or an OKX, whereas that might have been the case 5 years ago, 4 years ago. You need to bring monthly active user data, daily active user data, wallet interactions, all these different pieces to the table to say, hey, you want to get listed, you need to bring this information. And if you don't hit their targets out, this is what's made listing on the top tier venues much harder in the last, let's say, 1 year than it was before.
All right, that's a good thing for the industry, just focusing more on the fundamentals so that they're going to list more likely to be better fundamentally sound projects, and naturally they have a reputation as well, so that I think it's something to expect. The last thing, do you trade much on DEXs with your market making?
We do some things. We were trading on Swiss DeepBook for some time. We were one of the top 3 trading firms on DeepBook, which is a fully on-chain club. And we're working with a couple different chains on certain bridges and this sort of thing. And we do LP for some clients on chain, but we are not like doing MEV, sandwiching, front running, this kind of stuff on Ethereum mainnet or something like that.
Gotcha. I haven't heard of it's called DeepBook. I guess that's more of a it's on chain, but it's not like a people know the Uniswap and
Yeah, it's not
yeah,
Uniswap by volume for
yeah,
sure, right? But right now, I think it's still relatively early days for clubs on chain, but I think more and more we'll start to see it become a thing. DYDX has gone fully on chain with their order book on Cosmos, so it is interesting to see it, but it does add complexity. It certainly adds a latency, so it makes it harder to trade than a Binance for sure.
Gotcha. That makes sense too. Yeah, and I just was not thinking that. Yeah, these dexes are usually AMM, so that really it's not. It's supposed to be like an automatic market making system, so it is different because you guys are in the business of market making, so it's like this is supposed to a lot of that. Yeah, it doesn't
Yeah,
make
yeah.
sense to do it.
I don't know
Uniswap
that
with
it
this
doesn't
one.
make sense. It's if you're a project and you need a seed
Mm.
of pool and it's a Uni V3 style pool, you still need someone to be rebalancing your concentrated liquidity position for you. So there's open source protocols like EG or Arrakis or Mello that allow for this sort of thing. So you don't need a centralized market maker in on AMMs or like not a centralized, a market maker like us on AMMs, right? Because the actual matching and placement orders is automated, like you say, but you still need someone who is there to adjust the liquidity positions to make it a more efficient market.
So theoretically, you can be like the pool providers and be that adjustment mechanism, I assume. And then sometimes I would imagine that there's an advantage there where you're able to connect with centralized exchanges and balance out what you have in the pools and the decentralized exchanges. So there is some kind of benefits for doing that,
You
doing
have
both.
some firms in the space that do like CeFi DeFi arb, so they're arbing out spreads between the pool and the, let's say, Binance or something like that. So you pretty much have bots that are doing that all the time. And some of those bots are from like professional firms like ourselves, and some of them are just Joe Schmo, who like an engineer who's running bots on chain.
Gotcha. All right. Sounds good. All right. Really appreciate it. Yeah. Thanks so much. We'll hopefully have you back talking about market making or anything in terms of investing and trading. Any final words, any kind of words of advice for builders, investors, enthusiasts?
Nothing too special. I would say when it comes to builders who are doing a token, ultimately the most important thing is building the project, right? And that is inclusive. So it means, like we said, marketing community, but also it ultimately, end of the day, means building a real product and building something that people actually want or need. And if you're building a project, your focus shouldn't be what's the price right now. And you shouldn't be throwing a hasty fit every time the price goes down 5%. It should be really about being long-term oriented and building something for real, because that's the way to make the most money in this space. The short-term stuff makes some money for sure, but the real money, if you play your cards, you get a bit lucky and you have the right product and the right marketing, the real money is in the long run. So that's what I would say is my last piece of advice.
Sounds good. All right. But yeah, and if people want to follow you, Twitter, maybe we'll add the Twitter handle to the description on the YouTube video. And yeah, really appreciate it. Hopefully we'll have you back.
Yeah, I appreciate the time, man. Good to catch up.
All right. Sounds good, Andrew.
Take care.
Have a good one.